Testing, testing, 1, 2, 3. All right. Here we are. Every morning we come in here and we check out the ponies and we watch the Dow, we watch the S&P, we watch the Russell, and we watch the NASDAQ. Of course, those aren't the only markets that we watch, but those are our favorites. And that's what we've got up in the upper left-hand corner is the S&P. The bottom left-hand corner is the Russell. Bottom right-hand corner is the NASDAQ. And the top right-hand corner is the Dow. Now, this is the futures market. And so these are the stock indexes traded over in Chicago. We are not in the stock market, although we are trading stock indexes. So a little bit of a different game that we're playing over here. Being in Chicago, there are no pattern day trading rules, so we don't have to comply with that. If we want to day trade with less than $5,000 or with less than $25,000, we can do that. With $5,000, you can open up an account and rock and roll. Trade all day long, as many times you want. No restrictions. Last bastion of true capitalism on earth today. All right. So we are looking at the options today. Yesterday, we put on a straddle and a strangle, and we lost money. So today, we're going to do just the opposite. We're going to do the exact opposite of what we did yesterday. And what we're looking at here is the daily chart. Now, I have a bearish bias on this market. We're coming up in here, and we are getting ready to cross that downtrend. I'm thinking we're going to get a break on this thing. And it looks like we're going to get a little bit of a retracement. So that's kind of what I'm looking for on these markets, to kind of roll over the top and come back down. Are they going to come down heavy? They could, flush. But, that's what's happened in times past. When the markets decided they wanted to go, they flush and they go. Are we going to get that this time? Nobody knows. It could just roll over gently and just kind of come down gently. It could just break it and turn and start to rally once again. Of course, the market can do anything it wants, but we want to get in here and we want to put our options on. Now, generally, when we want to sell an option, we want it at very high volatility, not at low volatility, right? Low volatility time frame right now is before the market opens. That's why we bought them yesterday before the market opened. But today we're going to sell them. So generally, you'd want to do it during a high volatility. You want to sell during a high volatility time frame, which would be after the opening bell. But we're going to do it before the opening bell, because this is an educational site, right? We're going to learn. So we're going to come down here again. We're going to do a 0 DTE option, and we're going to go and we're going to do the exact same thing we did yesterday, only in reverse. So instead of buying, we're going to sell, and we're going to sell right at the money. And I'm going to go ahead and just mark it into that and get that on there before the opening bell. And then we're going to do the exact same thing we did yesterday. We're going to sell this one, and we're going to sell this one. So a straddle and a strangle, and instead of buying it, we're going to sell it. Now, we'll go through and we'll talk about this and see the implications of this. Talk about this here in just a minute. But let's get the opening bell coming. Opening bell's about ready to go. I could have gone out one more click on that, but we'll see. We'll see how that goes. So we're going to watch the opening bell here together, and then we're going to watch and see what happens to our options up there. And learn a little bit about options on what happens when you sell an option. We're going to watch. We might put some day trades on down here in some of these other markets today, but mostly we're just interested in learning about the options, right? Today's options day. This is options week. We're learning about options, and so we're going to be putting on our options trade. First thing we want to do is we want to come in here and let's take a look at the news. News is very important. We want to do our due diligence before we put our options on, obviously. Not doing a whole lot of due diligence here prior to putting our options on. So what have we got today? Impact, we're going to go to Impact 2, UTC 7, make sure we got that. U.S. markets, 7 a.m. So it's 7:30 right now, my time. I'm on UTC 7. So 7 a.m. we had some reports come in, nothing that really moved the market. Fed Goolsby. I love that name for us Fed guy, Goolsby. He's just a ghoul. Okay, at 8 o'clock, he's going to be speaking. And probably not going to move the market a whole lot, but look at all these Fed guys we got speaking today. 8:05, 8:45, 11 o'clock, 1:30. We got lots of Fed guys speaking today. Usually that moves the market. Now, they haven't got any of those tagged as high because they're not going to do anything but just scare everybody. Just tell you. What they'll do is they'll come in and tell you, oh, the markets are bad, but they're all so good. They're all so bad, and they're all so good. So they're going to give you a lot of, political speak, meaning nothing. That's why they probably don't. they're not going to change the interest rates or anything today. So it'll be interesting to watch though and see. It might not be the best day to be putting on a short position, but we'll watch and see. The whole idea is to learn, right? So we want to learn what these markets are going to do. Look at that Russell. Holy cow. Did the market open? It did. Market is open. Although that just started to drop before the market opened. So there's our down. We do have a down bias. So the S&P didn't flush with it. We don't want the S&P to move. We sold our options. So the whole idea now is we just want a dead flat market. Oh, that's a 30-minute chart. That's why. Let's come in here. We got to change this back. We'll bring it down to a 15-minute chart, 30 minutes. Okay, we're okay. We're all right. So we just want that market to stay inside that box. We're going to do a little math here. We're going to talk about that here in just a second. Holy cow. Look at that Russell flush. Flush and Russell, NASDAQ's on the rally. Dow flopping all over the place like a dead fish. S&P doing exactly what we want it to do, which is nothing. Okay, let's bring up our accounting window. If I can grab it here. I don't usually pull the accounting window up because it makes the chart so tiny. I'm trying to fit too much information on the screen at once. If you have a bigger monitor, you can get more stuff on the, have one of those nice big I got a nice big 4K monitor over here. But when I project out onto YouTube, if I have that big monitor on, makes it tough. Makes it tough for you guys to see. All right. Does that look good? What do we see in here today? So we're doing what we want to see the S&P do. We want to see the S&P do nothing, okay? We want it to do nothing today because we sold those options. So we didn't buy them. So if we come down here and see, we can see, well, we're already up $7. Okay, we got one option that's up 52 and the other one's down 57. We got another one that's up 35 and the other one's down 27. So we sold these before the market opened. And so the volatility was low at that point. Of course, we have to look a little closer. I didn't really go in and pay much attention to it because I was in a hurry to get it done. But I don't know how much the volatility had risen right before the market opened. But what we want is we want a dead market today. And we're getting a little bit of movement. Look at that Russell drop. So there's that white line from yesterday. We'll go ahead and delete that. Coming down and touching yesterday's, I'm not sure what that was yesterday. We need to go back and look. That market is pulling down. We're getting a little bit of a flag formation in here on the downside. Look how it's flagging, which means we're getting higher lows and lower highs. That's a flag. Okay, so generally speaking, you expect this thing to drop out the bottom of a flag like that. It's a continuation formation. Doesn't have to, though. It can definitely turn and start to rally once again. It can go either way. But usually we get a breakout of that flag formation, and it's usually in the same direction as the overall trend. But it doesn't have to go that way. It can always just reverse. And with the fact that the NASDAQ is actually on a rip, roar, and tear higher, it may pull that Russell up. But remember, the Russell is small caps, and these other markets are large caps. Okay, look at our options. They're making money. We're up $20 on the Straddle, and we're up $20 on the Strangle because the market's just going sideways. That's what we want that S&P to do. We don't want it to move. So we're up $47, $50 right now on those two markets. We're just going to let them ride here for a little while. They need to stay inside that box. Stay inside the box. Don't leave the box, S&P today. And what's the box? Well, we're going to calculate the box. We'll do a little bit of math here in a minute. We're just going to watch these markets. Look at the Russell. Can't decide which direction it wants to go. It may fake to the upside, touch those green dots, and then fall. And if that's the case, you could put a little order on there just for fun. You take a short position as it stabs those green dots. That's an advanced strategy because you're selling in a rising market, right? But you're anticipating that trend continuing in the other trend. It jumps up there. You take a short position right there just as it falls. So that's an advanced strategy that you can do. Still watching these options. We're up $60 on our options right now. Take it, land. Take it. Take the money. Take the money and run. Not yet. Not yet, guys. Not yet. Look at the NASDAQ. Popping higher, popping higher. It's popping off really good here. We're looking for this Russell to drop again. Maybe we'll get a second stab. Sometimes we get two stabs where we get that two bars go up, stab those green dots, and then it flushes. Getting ready to fall right now. You could take one right now, put in a little second position right here, and if it goes up and tries to stab that thing again, you could put on a second one on the rebound. That would be an extra advanced strategy. Right now, we'll just see if the Russell wants to continue lower. If it does, we'll take a little ride with it. If it doesn't, we'll just get right back out with a very small loss. Look at our options. Our options are up $65. Our Russell's up $20. We're green, 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 green so far. So far, so good. Let's see where this thing wants to go. I'm just short one contract. I'm not diving in with a huge position. We're just being real cautious and careful. We want to get a little green in the book today. Then you can be a little bit more aggressive. Once you get some positive numbers on your balance sheet, then you can be a little bit more aggressive on your next trade. But if you jump right in with a huge trade very first thing right out of the gate and you go red on it, that makes you feel bad. And then and you think I'm joking when I say that makes you feel bad. Your emotions are one of the biggest things that the driving factors of being a day trader. So when your emotions are down, you're not a very good day trader. When your emotions are up, then you're a much better day trader. So if you go green right out of the gate, you usually have a much better day than if you go red right out of the gate. Red right out of the gate, first trade of the day, you go red. That's no fun because now you just have to recover your losses, and then you're just playing catch up all day. And that's no fun. You don't want to get into that situation. So don't let your emotions get in the way, but you can't help it. They do. They get in the way. I'm going to back that off. That came in a little bit too fast for me. The market's not dropping like I want it to. I'm just going to put it on the green dot instead of on the one bar back. So we're going to put this on the ATR and just let it trail that green dot. Because I had it one bar back and that's a little bit close. I don't want to get knocked out if it wants to pop back just a little bit. Get too close. But it dropped fast there first. Now this little sideways, it's not dropping out the bottom as fast as I thought it might. It's being a little bit lazy in here. But the NASDAQ's starting to fall. Now, when it comes to the Russell, that doesn't necessarily always mean anything because the Russell likes to do its own thing. Let's bring this full screen so we can see it. See what's going on up here. So we've got our stop back here on the little green dots, and it just pulled it in all by itself, and you can see it's flagging again. This is not good. Created another flag. There it goes, breaking below that flag. This was the first flag that we got in on. Breaking of that flag, that's where we got in. Now we got another little flag here. I'm not feeling good about this. I'm going to bring my stop into break even. I want it to go decisively in my favor, and I don't want to take any money away from me. So I'm just going to put it at break even. If it comes back, we'll just stop out. I don't want it to make me go green. So come on, you dumb little market. That stopped us out with the scratch trade. Well, we tried. We'll wait for another setup. It might now turn and drop like a rock, and we'll feel bad that we did that, but that's the nature of the beast. Okay, so nothing's happening, which is why we're making money on our options. Nothing's happening because we're making, the market's kind of dead right now. Going into a little triangle formation over here on the Dow. What is going on today? Well, we're starting to get some drop down here on the S&P, and that's not good. That's not what we want. We don't want that S&P to move. We just want it to stay dead all day long. Don't go anywhere, S&P. Just stay there. We're going to do some math here in a minute and see how far out that thing can go. But for the most part, we just want it to be dead. So we're up $900 right now on that combined. Oh, and look, there goes our little Russell. We did get out too soon. I knew that was going to happen. Well, you rotten little dog. So it broke that little flat bottom, and it's going to drop like a rock. And we were short, and we could have kept it. We didn't. Too aggressive, Lan. You're being too aggressive. Too scared. I didn't want to start off with a red loss, though. I didn't want to have that thing turn around and go the other way on us. Live and learn. We all learn, right? We learn one way or the other. You learn. I'm a little aggressive with my stops. I really am. In the beginning, particularly, I don't like the market to come back against me once I first get in. All right, what can we do now? Guess we can go say hi to a few guys. Let's see who's here. Let's see who's in the house. All right, we got Bruce first thing in the morning. Good morning, Lan and all. It's nice to see you, Bruce. Great to have you. We got G Wiz. Hey there, all. Thanks for the lesson, Lan. You are welcome. Doing my best. Not making any money for you, but I guess our options are doing okay. We'll have to see if they hold, though. We got Matt Baker in the house. Nice to see you, Matt. Are you in this short, Russell? Did you get bumped out like I did, or are you still short? Will you put on butterfly options? Yes, Ben is asking, are we going to do butterflies? Yes, we will. We're going to take it in steps, though. We're going to go slow. We're not going to just jump into all the big, heavy hitters, because that's where we kind of want to end up, Ben. We want to kind of end up doing butterflies and condors and stuff like that. This strategy that I put on today is probably not one you'll ever put on, and I'll show you why. But I wanted to do it just for learning experience, right? We're in an educational environment. This is a class for my university, and I want to talk about what we've just done here. And so it's important to learn in steps and not just to kind of jump into the heavy hitters right at first. So we won't be putting on any butterflies today, but we will be putting on probably butterfly. What's today? Tuesday? Today's only Tuesday. We've got the rest of the week. We got 3 more days, and we'll have, before the end of the week, we'll have put on butterflies and condors both. All right. But we got to go slow, and we got to learn on the way. So Michael Bruce, good morning, Lance. Great to see you. Matt Baker says, missed the short this morning on Russell. Oh, so did I, Matt. I got in on it, but then I backed off. I didn't take it right out of the gate. You know me, I'm not a gate trader, I'm not a gatekeeper. We got Kirk Schwartz saying good morning. It's nice to see you, Kirk. John Mackey's here. Good morning, everyone from Canada. We got Kelvin Robinson, news in 20 minutes. What do we got coming up, news in 20 minutes? Kevin says we got something important coming up in 20 minutes. So that's what, 8 o'clock? 8 o'clock, we got Goolsby speaking. Yep, 8 o'clock, we got Goolsby speaking. So Oliver says, good morning from Oliver, Frankfurt. So Oliver from Oliver. Are you from Oliver? And we got Alex Katz. Guten Lecken. So we got, where are you from? Germany. That sounds like German to me. Larry McIntosh. How you doing, Larry? It's good to see you. So the market's dropping a little bit here. We're getting a little bit of a drop down on look at that rebound on the NASDAQ. We had that little wedge or triangle formation here on the Dow, and it's dropping out the bottom of the Dow. So the only one I tried to take a short position on was this Russell, and it kind of bounced me out. So, but it's being a little slow down here. The other one's moving. Then NASDAQ's falling. I'm actually bearish on these markets. I have a bearish outlook, a bearish bias. And I mentioned that at the first of the hour. Some of you guys might have missed that. Or first of the as soon as I got in. We go back out to the daily charts and take a look. You can see the reason is because this thing is peaking right up in here. If we just pull the Dow full screen, you can see this market's really getting up here high. We generally, look at how the market's moved in the past. When it turns, it dumps. That's what these little circles are pointing out. That it dumps when it likes to go. Sometimes it dumps pretty fast, pretty hard. But this market made three nice drives down. Drive 1, drive 2, drive 3. So 3 times a charm, this thing turns around, starts to rally. We oftentimes will get a head and shoulders formation in here. That's what I was expecting to happen. I thought it was going to come up here, make a nice little head and shoulders formation, and it didn't do it. Of course, I like to see that head and shoulders formation come in and have that natural trend line. So that's where I was looking for this thing to come in. I want to see that natural trend line be part of that neckline. So you draw that up there as a natural trend line. And then that kind of tells you where that thing's going to curl right in there somewhere. And it should have got a little right shoulder in there, and we didn't get it. It was just too much strength. It did give us a little flag right in here. So we got a little flag formation right in here. And then it took off like a rocket ship. Now I bought right down in here and loaded up on a bunch of shares. So this took me into the market, and I've been taking my profits all the way up this thing. But now I've got an option in here. I got a couple of markets that I'm doing this on, but I've got a couple of put options in here in anticipation, just to protect myself to the downside in case that thing flushes. So I am bearish on this market right now. Same with the NASDAQ. I think the market's going to come down. The Russell, it's looking a little toppy up in there as well. And then, of course, the S&P is looking very toppy. We got three indicators in here that are kind of showing that we're crossovers. The blue light's the slowest one. That's the one that's the Elliott wave pattern that's tuned into the Elliott wave. We count the Elliott waves with the blue lights. The red lights, that's just the parabolic SAR. And then the green lights, that's the ATR, average true range. And so you can see those two are matching up in there. And when that happens, that's usually a pretty high probability that we're going to get a drop. Now, I'm bearish on this market, but we put a neutral position on, okay? These are neutral positions. So let's come back in here to our 1 minute charts. Now I got 1 minute chart on everything except for the S&P. On the S&P, we're looking at a 15-minute chart. So it's starting to rebound and come back a little bit up in there. Now on the strategy that we've got here, oh look, there's that crossover on the Russell. That's why we were talking, that thing broke to the upside. So we're still considered in a downtrend on the Russell. If we pull that full screen, that red arrow right there tells us we're in a downtrend. So this could just be a counter trend. We are on the backside of the MACD. That's what that's telling us right there. On the backside of the MACD, it's curled and started to rally. So it's not just a downtrend as far as the MACD is concerned. But this is generally what happens. We'll get a little bit of a pullback in here. And if it doesn't go far enough back to give us another red arrow to the upside, then we're still in a downtrend, and we'd look for this market to turn and make another drop and give us that A, B, C, D pattern, right? So if this market will come in here just right where that red arrow is, actually we want to go to the peak. So back in here, the low and the retracement. And if that retracement goes up one more, we'd just drag this, we'd move this up to the next one and up to the next one, up to the next one. So each one you go higher, higher, higher until you don't get a higher. And then once you don't get a higher, that's your trigger for the downside. And that bar right in there, and then we would expect it to turn and fall and go right down that scale just like that. And that would be the A, B, C, D pattern, okay? So that's how you would trade this one if you want to take a short position. Now, right now, it's coming into a flag, and it doesn't mean it has to break out and go down. That's just the bias on this thing, right? It can definitely turn and go back up again and continue to rally up out of this little flag formation. There's nothing says it can't. Market says it can do anything they want. It's just where are you willing to put your money on the line? So we'll take another shot at it right here. And I'm going to not be so aggressive on my stop this time. We're going to hold back on that for just a second and see if it won't give us a little bit of a drop here. If it doesn't, we'll just get right back out, take a small loss. But we want to see that thing drop and just kind of continue down in that downtrend. We want to see it break those green lights. We could come in here and we could get a little bit more aggressive on this one. We could come in and drop one on the green lights, and if it breaks that, we'd be in with two short. But we are on the backside of the MACD, so this could be just a little pullback on the. It could be an ABC to the upside, right? A, B, C, come down here, pop this one here, and turn and start to rally once again and head back up to that blue line. So we got to keep that in mind. It just took another short position, so we're short 2 at this point because it broke that green light. So now it's backing off on the green light, coming back up. Look at that. It's gonna spank us. It's gonna come up. It's not gonna fall. Come on, you little dirty dog. So it broke the green lights and then backed off. Didn't want to go. We got a lot of going on the screen right now. Let's clean some of this off. So we could reverse and say, well, if it wants to go long, we'll take a long. Remember, a broken trend is oftentimes the best trend. But the thing we don't want it to do, which these stupid markets have been doing lately, especially where we got Google's be speaking in 10 minutes, it could just go sideways. And if that's what it does, that's not good for this strategy. It's good for our options, which you can see over there. Our options, we're still up making money on our options. We just want it to drop here. So it broke our entry, got us in. You can see I've only got a stop for one right now, and I'm short two. So come on, buddy. I don't think they really care what Goolsby's going to say. I think they're just being lazy. Come on. I hate getting into lazy markets. Just wait, see what happens. Keep an eye down there. You can see we're still up on our options. We're up about $100 on our options. That hasn't changed for the last few minutes. We've been up $100 for the last 10 minutes. There, we're getting a little drop on the Russell. Come on, buddy boy. We are bearish on these markets, remember. I do think they're going to fall, but we're looking at a macro level here, this tiny level. They can still go up and still be in the process of being in a downtrend. Our major indicator, our bulls and bears, is telling us we're still in a downtrend. We're still bearish. That's what that's telling us right there. You are in a bear market land. This is not the order to take in a bear market. This is a buy signal in a bear market, so we don't take it. There, we got another bear signal. So we finally got our bear signal in a bear market. So we're bearish. Bear signal in a bear market makes you bearish. We don't want a bull signal in a bear market. This identifies the market. Bearish. This identifies the entry. Bullish. You only want to take bearish positions in a bearish market. You only want to take bullish positions in a bullish market. All right. Finally, this thing's starting to move. Don't know how far it's going to go, though. Its first goal should be to come down here and test this area of support. So we got across the bottom of those bodies, and we got across the bottom of those tails. So a little area down in here. So we could do a scalping trail. If that thing had come down a little bit, we could take some off just to cover our expenses, and then we could start trailing the second one out. So that's what I'm kind of thinking here. Trail, ATR. We'll put that on the ATR at this point. And we're only trailing with one because we're going to scalp one out if it'll come down here far enough to give us enough money to scalp. There's just nothing in there right now. $45. That probably would have covered our expenses, because our expenses at this point are back to where we get stopped out. Oh, look at that. You dirty, rotten little bugger. Lazy markets. Is that what it's going to be today? Scalp and trail. Let us scalp something. Come on, you dirty, rotten little bugger. Drop, drop, drop. You got to give us something to scalp here so we can cover our expenses. We want to cover our expenses so that if it comes back and stops us out, we're still green, or at least scratch trade. It's called the scalp and trail. Go in with two, take one off, just enough to cover our expense of what it would cost if we got stopped out, and then let the other one trail out. And that way you got no loss. You can still at break even. But this market's being got about a $40 in there right now on a single. We're up 65, 35. I don't know if that'd cover this. Come on. Come on. Should we scalp one out already? All right, it's being stupid. We'll take one off. We scalped a little bit out just so that we can cover our expenses in case we get stopped out. We don't take a loss. All right, we're break even on that one, so we're okay. So now we'll just dead market going sideways. Don't want to take a lot of risk. Goolsby. Was it Goolsby? Goolsby speaks at 8 o'clock. And we just got stopped out. That just stopped us out. And scratch trade. So we barely made it. Barely made it. Look at this market here. Dow Jones just going sideways. That would have been a good one to put a neutral option strategy on too, right? But we got it over here on the S&P. You can't. There not a lot of options over here. See, nobody's trading them. There's options there, but nobody's trading them. Look at the volume open interest. 0. That's the 2-day. That's the best we can do. We don't have any 0 DTEs on the Dow. So that option expires on Friday, and nobody's trading them. Open interest, volume, nothing. Go look at the NASDAQ. Same thing. Nobody hardly is trading them at all because we don't have a 0 DTE. We have to expire in 2 days. So on Friday, so you'd have to have that for 2 days. Nobody's trading them. Open interest, volumes, nothing. You got a couple right up here. Looks like somebody's put a iron. There's some people putting some. Oh, they don't even look like iron condors. They just look like that. Just looks like to me that looks like a vertical spread. Somebody's got a vertical spread on up there. That's bearish. That shows that somebody's selling up there is what I think that is. But they've already done it. Looks like no, they're open interest. So they still have an open. And then the little Russell down here, same thing. You're not going to get anything down here either. We've got 2 days till expiration. The options are all dead. Nobody's trading them. You got a couple in here. It's got some open here and some open here. So it looks like you got a little iron condor on there. Somebody's putting some iron condors on there. Or maybe some butterflies. I don't know. We'll talk about those. But all the action is up here on the S&P because we have 0 DTE action. Okay. So we got 0 DTE and see all the volume, all the open interest. We got lots of volume, lots of open interest. Everybody's trading the S&P. So that's why we're trading the S&P, right? This is a Me Too market. You want to go where everybody else is. You just don't want to do what everybody else is doing. You want to go where everybody else is, but you don't want to do what everybody else is doing. Okay, that S&P is doing good for us. It's just kind of dead, hanging out there in the center. $55, $40. We're going to go do some math on it here in a second. Let's see what Goolsby does. Goolsby's going to start speaking here in a couple minutes. See if the market moves at all for Goolsby. We sold these options. We didn't buy them. Yesterday we bought them. If you want to see how to buy Straddles and Strangles, go watch yesterday's class. That was a really important class. So if you guys didn't see that, that's kind of the very important one. This is a follow-up to yesterday's class. And we lost money yesterday. Why? Because we bought in a dead market. So today we decided we were going to sell and hope the market's going to be dead. It's going to be not a lot of good news. I mean, we talked about this earlier, right? But we'll pull it up again. Not a lot of good news. If you go out here to tradingeconomics.com, tradingeconomics.com/calendar, that's the calendar I look at. There's a lot of calendars you can look at. There's nothing. I mean, this just happens to be the one I like. I'm not associated with these guys, don't have any affiliation with them. It's just the calendar I like. If I could find a better one, I would go to a better one. But I've switched around to 2 or 3 in the past. You've seen me look at different calendars, but this is kind of the one I look at right now. It's the one I like the best. You'll notice that tomorrow at 6:30 in the morning, there is a big mover. Okay, so if we come up here and go to the impact and we just put 3 stars, there's no 3-star impact today. So today should be a good day for a dead market. Doesn't mean that the market can't move. There's always outside, events that can cause the market to move. But today we should have just a kind of a dead day. No real big news. There's 2 impact, and that's okay. If you go to 1 impact, there's a lot of little nothing things going on, but they don't generally move the market enough to worry about. So I go to 2 impact, and that's where we got all the Fed speakers today. So we'll see if they move the market. If they do, it's going to make that, if the market moves, it'll make these options lose money. These options need to be dead. Yesterday we had the ones that needed to stay alive, right? They needed to move hard, good and hard. Today we're just collecting premium. So the whole idea of what we've done today is we've sold these these options. All right. We sold, this is called a short straddle and a short strangle. Now remember, the straddle is the one that's dead center. We put them right on top of each other. Okay, that's a straddle. When you strangle, they got a gap between them. There's some air between there, actually strike prices between there. So these out here are the straddle. Now, that's kind of my little pet peeve. You guys all know that I laugh about that all the time, because if you're a farm boy from Utah and you put one foot on this side of the ditch and you put one foot on this side of the ditch, they're not on top of each other. They're straddling the ditch. So, but that's not how they named them. If you got this one out here with the gap between them, you'd think that would be the straddle. That's the strangle. Okay. And then the one that's right on top of each other is the strangle, or is the straddle. Excuse me. I get them mixed up because they're backwards. They're wrong. They named them wrong. In my opinion, they're wrong. So that's how you know how to know, because a straddle is a strangle and a strangle is a straddle. So they named them wrong. They've got them backwards. And so that is how you know which one's which. The one that's on top of it is the straddle. The one that's got a gap between it is the strangle. And that's all these are. So we started off yesterday. We bought a straddle and we bought a strangle. That's a long straddle and a long strangle is what we call that. And then this one here we sold. So this is a short straddle and a short strangle. Okay. Long straddle, strangle. That's when you buy it. Short straddle, short strangle. That's when you sell it. So when you buy it, you want it to move because it needs to cover the cost of the premium that you paid for it, right? It's got to cover that cost. If you want more information about that, go watch yesterday's class. Today, we're going to talk about the short strangle and the short straddle. Since yesterday we bought them and we paid the premium, who did we pay the premium to? And we lost $800, right? We had to pay the premium to the guy who sold it to us, and he made $800. Well, today we're going to be that guy. We're going to be the guy that sold them to somebody who bought them. So we sold them, so now we get to collect the premium. But what's our risk? Now, because these are short strangles and short straddles, and we sold them, we have to have a margin account. To sell options or to write them. Now, remember, we want to be very careful about using the word sell, because you can sell something, which means you put one on. So that's what we've done here. We've actually sold them. So we put them on. Selling them doesn't mean getting rid of them. That means taking on the risk by selling them. So we have to be careful in using that terminology. So we don't generally say sell when we get rid of something. When we talk about options, we say liquidate. All right. So we know the difference between selling an option and liquidating an option. If we liquidate, we're getting rid of it, but it's a different word that we can use to make the differentiation. So we liquidate our options, that's getting rid of them. If we sell an option or write an option, that would be the proper terminology. If we were to actually write an option, that would be selling the option to somebody else and collecting the premium. All right. So we get our terminology straight there. So this market's coming right back dead center to where the market was when we put those options on. Look at that. And our profit now is up $155. So remember, yesterday, this exact same thing happened, only we bought the options yesterday and we were down $155 at this point. So today we sold the options or wrote the options. So now we get to collect that premium and we're up $150. Take it, Len, take it. Well, you could just go in and liquidate it right now. You'd be up $150. Happy go lucky, away you go. And you made $150 today. But we're going to hold on to it because we want to learn. We want to watch and see, because the more time that goes is how you make money on this one. So the way you make money when you write an option is by waiting for that time decay. And that's what you want. As long as that market's hanging around in that dead area. And what's the dead area? It's the area that we can do the calculations just like we did yesterday. And we're going to have kind of a cone of probability. All right. So if we're going to come in here, let's create a cone of probability. Let's do that right now. But before we do that, I want to bring up this slide one more time and just remind you, add to stage. All right. So remember this slide from yesterday? So Kelvin's saying that maybe you should close your sold contracts. No, I'm not going to sell them. I'm going to let them run clear until the end of the day. I'm not going to sell them at all. You could, if you thought that the news was going to be a big enough event that was going to move the market, you wouldn't have wanted to put them on in the first place. That would have been that game. So I'm not selling them because this is not a real money account. This is a demo account. This is an educational environment, and we're trying to learn what happens. And so if the market actually did take off, Kelvin, on a big news event and we had sold options, that would be a great lesson. That would be something we would want to watch and see what would happen so that we know for next time not to do that, right? So that's kind of the idea. But you are correct in this sense that I have really ugly, a really ugly liability right now. And that's what we're going to talk about right now. But I want to kind of make this a lesson so that we can learn. But given the fact that we put these on, if there was big nasty red news, I wouldn't have wanted to put them on in the first place, right? That's the thing we need to learn about what's going on here. So we're just learning here. And yesterday we bought them, so today I wanted to sell them and just show the difference. If we had big news and we sold them, we would have a great lesson to see what not to do, right? So since it's not big news, I don't think we're in too big of a risk at this point. We'll see. I do have a down bias, as I mentioned. So let's talk about this probability one more time, and then we're going to draw our cone of probability and take Kelvin's advice and, be careful. I think that's what he's trying to say is, look, be very careful. We have some important news coming up. So cone of probability, calculating the delta cone. During any span of time, 68.2% of the time, stock prices fall within a +1 and a -1 standard deviation of the average. All right. So if we think about that, a market 68.2% of the time is not going to leave the single 1-to-1 standard deviation. So we have basically very close to a 70% chance whenever you put on a straddle or a strangle in this way of this thing paying off. So the odds are in your favor. Okay. And we kind of proved that yesterday, didn't we? Yesterday, the market didn't do anything. It just died and we lost all of our money. So we lost our entire premium. I've got that. I did a screen capture of it. I'm going to bring that up and show it to you of what happened yesterday. But we held it all the way till close just to see what would happen, right? Same thing we're going to do today. We're going to hold these all the way to the close. Now, you don't necessarily have to hold them all the way to the close, all right? I'm not teaching you to hold them all the way to the close. I'm teaching you what happens if you do. If you get up and the market starts to lose money and you've made some money, you can liquidate these things at any time, all right? These are American style options. Once you put them on, you don't have to wait till expiration. You can take them off at any time. And so Calvin's advice of maybe we should take them off before a news event is good advice. The better advice would have been don't put them on in the first place before a big news event. Okay, so we got to be very careful about when we put these on. Right now, we're in an educational environment. We're just learning. So I can't say, well, we're not going to put it on today because that wouldn't be a good lesson. We got to put it on. So today is the lesson where we learn about these options. We're going to put them on, whether it was a good timing or not. As you stick with me over the next weeks, we will start to do more of that. We'll say it is not a good time to put this option on, so we're not going to put it on. All right. We will put on a different option, another one that we've learned about for different opportunities. But for today, the lesson is selling options. So we're going to just outright sell options, and we're going to get into that. And the advantages and disadvantages is what we're going to learn today. So stocks fall within a 2% deviation only 95.4% of the time, and only 99.7% of the time stocks will end with a +3 deviation. So that tells us that selling options has a much higher probability of success than buying options. All right. So we do a lot of selling of options because we like to collect that premium because it's a high probability. But if we get into a situation where the market might move very strongly, we would want to buy the options, right? But you need a big, strong moving market, lots of strength, lots of movement to make an option worthwhile, to make it to. I've seen lots of guys lose huge amounts of money because they keep buying options and the market just doesn't go anywhere. It stays in that standard deviation. And if that's the case, if that's what happens, they lose their money. They lose their premium. Who do they lose it to? They lose it to the guy that sold it to them. All right. But you can lose money selling options too. I mean, you can lose a lot of money because you have unlimited loss potential, right? But think about that, because if you sell an option, you have to give the guy on the other side unlimited profit potential, which means you take on the unlimited loss potential. And if you take on the unlimited loss potential, then there's a possibility you could lose a lot of money. But when you buy an outright contract, let's say you just go buy a contract, well, you have unlimited loss potential. So it's not really any more dangerous to sell an option than it is to just buy an outright contract. And you do that all the time. And you don't go, oh, no, I can't do that. I've got unlimited loss potential. Well, you got unlimited loss potential when you buy a contract. Why are you scared about unlimited loss potential when you sell an option? It's the same thing. In fact, it's even less, because when you sell an option, you sell it and you have a lot lower delta. You have a delta of maybe 0.5 or 0.2. And if you have a delta of 0.2, you're only making or losing 20 cents for every dollar that the underlying stock is, or the underlying contract is losing or making. So you even have less of a liability when you sell an option than you do when you have an outright contract. Okay. So think about it like that. Selling options isn't as dangerous as getting into an outright contract. Right? So, but we have to take into consideration our Kona probability. So let's go calculate our Kona probability in the software. So let's come in here. And the way we did that yesterday, remember, we calculated the Kona probability based on where the market had to go to be profitable. Well, we're going to do the exact same thing when we sell it, when we write the option, and then the Kona probability is just reverse. It's stay inside of the cone, don't leave the cone. So when we buy them, we want the market to leave the cone of probability. When we sell them, when we write them, we want the cone of probability to stay inside of the cone of probability. So let's calculate our cones of probability. So first of all, the cost basis is where we get that. So we have a cost basis of $745, which is almost exactly the same as what we did yesterday. In fact, let's pull that up right now. I think now would be a good time to pull up yesterday's. I think I saved it. Oh, here it is out here. I think this is, yeah, that's the one we put on. So I think that's where we, yeah, that's the one we ended up on. Right there. So that's just looking at it the way we were looking at it yesterday. We're looking at it from the 4 markets. So this is what happened at close, almost right before the close. Okay. So this is when I took it off right before the close of the market. And you can see we were down $277.50 on the Straddle and $197.50 on the Strangle. Yep. Straddle and the Strangle. So we lost money. That's our yesterday's checkout. This is when I just went full screen on it. So it's the exact same numbers. You can just see where we were. And the market just ended up, look at that, dead center, almost exactly right where we opened it. This was a 30-minute chart. So each one of those bars is 30 minutes. And that market just went dead sideways the whole day. And we lost everything because we needed to leave the cone of probability, right? Leave the cone. But yesterday it stayed right dead center of that cone. And so we lost our entire premium to the guy who sold it to us, right? Who sold us those options. We bought them. The guy who sold them to us made all that money. That's what he got. He got to keep all that money. Now that was his max profit potential. The max amount of money he can make is the premium that he collected, right? But heck, that was $475 we gave him yesterday. $475. I didn't want to give him that, but he got it because he sold them to us. And the market did what he thought, which was go right dead sideways. Okay. So we're going to do that today. We're going to be that guy. We just reversed those roles. So now let's go and draw our cone of probability. So the first one, the way if you remember yesterday, when we drew our cone of probability, we had the cost basis of 745 for the Straddle, and we had 225 for the Strangle. So let's do the Straddle first, $745. It's very easy. All we do is we just go $745 from where it's at. Now, that's both options combined, right? That's the premium from both options. So you have the sell call. We paid $380, or we sold it for $382. The buyer bought it for $382. The sell put, the one that we sold it for 362. The buyer bought it for 362. So you combine those two together, that's $745, and that's how far the market has to move for him to make money. So it has to go $745. We're going to draw that out there, 700, about almost exactly to where those red lines are. Okay, so we're going to come in here, and we're just going to draw our cone of probability. And the first thing I'm going to do, I'm just going to draw the box. Well, it's the red lines. So our cone of probability is from where we got in to where that thing expires, right there. That's that one, and then we'll just draw the cone to the bottom side. So that's our cone of probability on the Strangle. No, on the Straddle, sorry. On the Straddle. So that's our cone of probability. If it leaves that cone of probability, if it comes up into this region up in here, this is where we're going to probably lose money, right? It'll lose money. It'll show a loss. So in the beginning is your most dangerous time because it's the cone of probability is small. If it comes up into these regions up in here, right, that we would show a loss in our money. But the cone is actually like this. So if it comes up and it goes out in here, we'll show a loss on our cone of probability. But the closer it gets to the purple line, if it stays down inside our cone, if it comes back into the cone, it can leave the cone. It just can't stay out of the cone. It can leave the cone. It can come up here. It can come up here. We'll show a loss if it does. But if it comes back into the cone, right, as long as it hits that purple line inside the cone, we got to keep all of our money. All of our money. We got to keep all of the premium. But if it leaves that cone, that's where we lose money. All right. If it goes 1 penny outside the cone, we don't get it. Why? Because that's break even for him. That's break even for the guy that bought it. So he gets to get his break even back. That means that if it's 1 penny outside that red line, we have to pay him his break even. But if it's 1 penny inside that red line, we get to keep we get to keep it all. He loses it all. We get to keep it all. Okay. So that's the game we're playing. We need it to stay inside that cone of probability, and the cone grows as it gets further out, right? So the cone's small here in the beginning, but out here, the cone is really big. So we got, as time decays, that's how we get paid when you sell or write an option. You collect the premium as it dies. Now remember, time is the only value that we've got in this thing. We're selling him opportunity value. We're selling him time value. And so the time has to decay, and that's how an option that you sell or liquidate, or not liquidate, an option that you sell or write, that's how it gains value, is by losing time. Okay. So it's sitting right dead center. That's really good for us. That's what we want. We do not want to see this market move at all. We want it to stay inside that big old cone and touch that purple line. If we do, the closer it gets to the line, the more money we make. And the max amount of money we make is the maximum premium that the guy paid us. So on the Straddle, we can make up to as much as $745. And on the Strangle, we can make as the Strangle, we can make up to as much as $225. So that's our max profit on there, but we got to wait for the time to decay. And time is not good for us because that could give it time for the market to move. So that's our advantage. That's our disadvantage. Okay. So right now we're up $230. Now, before the ghouls bespoke, we were up only $100. So now we're up $230 because more time has gone by, and that market is sitting right at max profit. I mean, that red line in the center, that's max profit for us right now. So that's right where the maximum amount of profit that we could have at this time in the game is right there, $230. So the other disadvantage of what we've done here is that, remember, when you buy an option, you have no margin requirement. Okay, no margin requirement. So if you can afford it, you can buy it. So yesterday we paid $745 for that option. That's all the money we needed in our account was $745. Same thing with the Straddle, the Strangle that we sold. We sold it for about $225, right? We sold it for $225. Well, that was all the money we needed to have in our account, $225. That's it. So the problem with selling an outright option like this, by just going, this is called naked. All right. We are naked. We have no insurance. We have no protection. We are only insured or protected by the money we have in our account, how much money we have in our account. So this is a naked strategy, naked options. We have no insurance policy. We have no coverage. We have nothing. And so we have, if you look over here, the used margin. Okay. To sell options, to write them, you have to have a margin account. And because they believe that you have unlimited loss potential, that's dangerous, and you don't have a stop on there. So they make you have a huge margin amount. All right. So a margin amount of way outside the 3 standard deviations. And that's how they calculate the margin. They say this damn guy's scary. He's got naked options out here. We're going to charge him an arm and a leg because that's a big risk. So look at my used margin. I had to put up $11,979 to put on that option, to put on that straddle. So that's $745 option that I lit up, that I wrote. I get to collect $745 if it stays in the cone of probability, but I had to put up $11,979 to put that thing on. All right. $11,000. Now you're used to trading this thing with contracts and putting up $1,000, right? And saying, I can buy a contract for $1,000. And you have basically the same risk. You have the same risk. I mean, you have unlimited loss potential when you put on a contract and you only have to put up $1,000. This thing, the maximum profit you can make is $745, and you had to put up almost $12,000 to put that thing on. Think about that. And the same thing for the other one. Look, we only made that cost basis was $225. That's the maximum profit we could make by putting on this writing this option. $225. That's all we can make. And we're taking unlimited loss risk potential. So you're like, well, I could $225 with unlimited loss. I could take a contract, put on a stop order, limit my loss to the stop order, and not have to put up $11,900 to put it on. Why am I trading an option to collect $225? That's a good question. Why would you? Why would you do that? You wouldn't. That's why I said we're putting on an option strategy today that you'd probably never put on. You'd probably never do one of these. Okay. I would advise you probably not to ever do one of these. Not that we're not doing it, because this is an educational environment. This is a safe environment. We can do it. It's a demo account. We're learning. And what we're learning is that you're probably never going to put one of these on. Although you're sitting here going, well, it's pretty damn good odds. Lan, you just ripped the rug out from under me. I was so happy about what was happening here. I'm up $232, but I had to put up, what? $25,000 to do that? You just shattered all my hopes and dreams. Don't worry. I wouldn't do that to you. We got we can solve that problem. We can solve that problem. There is a way we can solve that problem. And I know Kelvin's already got it in his head. He already knows what the heck we're talking about. Because we can put on an iron condor or an iron butterfly, and it solves that problem. All right. So we're not going to do an iron condor today. We're not going to do an iron butterfly today. We're going to learn those tomorrow. Okay. So we'll put on an iron condor tomorrow and an iron butterfly tomorrow. I think we should put on, maybe we'll just do a butterfly tomorrow. Okay. Because putting 2 of those on at the same time is more difficult than putting on a couple of straddles and strangles. Straddles and strangles are easy to put on at the same time, and you can compare them. But now that we've got the comparison going, we're going to learn tomorrow what a butterfly is, and we're going to learn what a condor is. All right. And we're going to learn also this week, we'll probably learn about vertical spreads and what I call chicken wings. All right. Chicken wings. So that's what we're going to learn today. And this option is just doing beautiful for us. Look at that. It's dead center, sitting right there at our max profit. Our red line in the center is max profit. We're up $242 right now on our $25,000 investment. All right, but we're doing good. We're doing good here. We're staying in that cone of probability. Let's calculate the other cone of probability. That was the straddle cone of probability. Let's calculate the strangle. The strangle is $225. So we have to go $225 outside of the cost of the option. So $225 brings us out here. Okay, so that's our cone of probability. We're going to draw a line out there just so we can get that lined up. There's our line, and so we're going to draw our next one. This is our cone of probability to collect all the premium all the way up to there on our, and I'm going to Well, let's see. Let's draw it in there. Let's do it right so you can see how I do it. All the way down. Center line brings it all the way over. There you go. So line it up perfectly, just like that. And there is our cone of probability right there for the straddle, for the strangle, for the strangle. So we got two cones of probability, one for the strangle, one for the straddle. Okay. So the market has to stay inside of that outer arrow for the out of the money version of the options, which is our strangle, our straddle, strangle. This is our strangle out here. Okay. So that's the cone of probability for the strangle. The market has to stay inside of there. Now, if you would have bought that, the market would have had to leave there, right? The market would have had to go all the way outside of that arrow up here to make that thing profitable. Now, could it do it? Yeah, of course. The market could go up there. It could really rocket and take off and go up there. But more likely, probably, right? More likely, we know that more likely we have a higher probability this is going to stay inside that cone. Okay, it's going to probably stay inside that cone. So that's the cone of probability for the straddle and for the strangle. And all we have to do is just wait. You don't have to do anything. Just wait, cross your fingers, and hope that it stays inside there. Now, what if it doesn't? What if it goes way out there? What do? You start losing money. What do you do? Oh, no, my straddle, my strangle, losing money. What do I do? Well, if it's early in the day and it happens, up here at the front of the day, then you don't do anything. You just cross your fingers and hope it comes back down into the straddle or into the cone of probability. Or even if it just goes up there, what if it goes and rallies? And we see that a lot, right? Markets will just kind of rally and then just stay there. Well, that's okay too, because if it just rallies in the morning bell and comes right up here, and then it just stays there, well, if you just wait, eventually the cone will come and catch up to it, surpass it, and the market closes and still inside the cone. So usually, not that you can roll and you can do, there's all kinds of fun things we can do to try and protect ourselves against a rising market or a falling market when the market, when our options that we sold are dying on us, we can roll them out. Most of the time, we don't want to do that. Most of the time, when you start screwing around with it, it makes it worse because it costs money to do that. And so we can not do that and just wait and see if the cone of probability which is moving pretty aggressively. That's a pretty aggressive move, right? The cone of probability might surpass where the market rallied to anyway, and you're going to end up inside the cone of probability anyway, even if it drops out the bottom, right? Market drops and tanks way down here and then doesn't really rebound. It just kind of goes sideways until it closes out way down here. Well, you still make your whole dollar amount, 100%. All it has to do is touch that purple line inside that box, inside of that cone of probability, and you make your 100%. So if you get nervous beforehand, 12 o'clock noon comes and you're like, oh, I'm nervous. The market's out here outside of my cone. Usually the best thing to do is sit on your hands and just wait for the cone to surpass where the market's at. But if it just keeps going and keeps going and keeps going, are there things you can do? Yeah, there's things you can do. And we're not going to be having one of these on anyway. We're not going to ever really trade this strategy. We're going to actually turn this into an iron condor or into an iron butterfly. And that's what an iron condor and iron butterfly is. It's a straddle and a strangle that have been protected with insurance. And we're going to learn about those tomorrow. Okay. So today I'm just going to let this run. We have done our, not a whole lot to do at this point. You can just kind of walk away and, you want to stay close and come and check it every now and again. But for the most part, there's nothing to do. You don't do anything. You just wait. And that's, for some people, that's the hardest thing to do is wait. We're up $267 on it right now. If you want to take it right now, you could walk away. And then, you made your $267 for the day. Go cook some eggs, not look at it again. Whatever makes you happy, right? So now that we've done that, let's come in here. Let's go back to see what else is going on. So Little Russell's been moving. This is where we tried to take a short position and we got burned out on it. It didn't go. But it did. Oh, look, it kind of choppied all over through here. Good thing we didn't reverse because we'd have probably been pretty upset about that too. Got chopped out right there. But that was not even a decent run there. It looks good. You're like, oh, that looks like a good one. But by the time you get your stop move to break even, you get stopped out. Even if you get stopped out, I guess it was okay. I mean, even if you got in right here at the perfect entry, you got stopped out right there, $70. So that'd have been tough. Those are not big moves. This is the move right here. This was the move right here this morning. That was the move. And that was from before the market opened, $580. And this little rebound is on the back side of the MACD. Remember, we talked about that before? The MACD kind of tells you where the strength is. So if the market starts to fall out, we got the bulls and bears right there. The market starts to fall out, the MACD drops. And as soon as that MACD starts to rally, you're on the back side of it. Now, it could turn and fall once again, and that's what we were kind of looking for, and then you'd be still on the front side. But once it came in here, we got this reversal arrow right there. We went bullish. And you're on the back side of that MACD. When you're on the back side of that MACD, it's usually not enough strength to drop and make you any money again. Okay, the big move is in the back side of the back and the front side of the MACD. Whether that's, let's see, delete all those. So that reversal, that backside climb out of there, coming back up to that blue line. Remember, that blue line acts like a rubber band. It pulls the market to it. It's like a rubber band. Now, you notice it kind of follows it too. If the market drops, it's going to come down, but it wants to come back to that blue line. That blue line is like a rubber band. That's the volume weighted average price, or what we call the VWAP. So not really doing anything. The NASDAQ's kind of dead. The Dow looks like it tried to make a little rally in here. It was ugly. And right at 8:15. Who spoke at 8:15? They moved the market a little bit. They said something that the market liked. What the heck's going on here? Sorry, I'm struggling to get my calendar up. Here we go. So that was right at, what did we say? What time? 8:15, right? At 8:15, somebody said something that the market liked. So 8:15, 8:05, Fed Waller must have said something 10 minutes into his speech that the market liked. Fed Bowman came on at 8:45. Fed Barr comes on today at 1:30, 30 minutes before the market closes. 2:30, market closes at 2 o'clock for me because we're on UTC 7, so 2:30 this. API crude oil is coming in, so we're not going to be watching crude oil at that time of the day. So this was at 8:30. So Fed Waller, he's been saying some stuff. Fed Waller made that happen, and Fed Bowman doesn't come on until 8:45, so he doesn't come on for 10 more minutes. So Fed Bowman is the one who's talking right now, and he's moving the market a little bit. He's giving him a little positive reinforcement in there. He's caused a bull market in here. All right. So he must be saying something people like. Now, the NASDAQ doesn't like him very well. NASDAQ's dumping, but the Dow likes him. Dow traders are seeing his comments as positive. If that's what's moving it, it might not even be what he's saying, but this is kind of telling right here. The fact that this kind of went crazy right when he started speaking. So very telling. Very telling in my book. All right. How's our options doing? Still just staying in that cone. That cone's widening and broadening out as we get more time. We're up $290. Did we break 300 on that thing yet? I don't think we broke 300 yet. All right, let's go over and look at the stock market, because we do have some trades on the stock market, don't we? We have some options that we put on the stock market. Kelvin, I'm not sure what you're asking. Too close position. By each leg, too close versus by the position, too close. Which do you prefer? Are you talking about how far the distance out that we've got them? Could we put that strangle further, the legs further out? We could. Yeah, you could. Well, what you want to look at is the delta, how much money you're going to make, what kind of risk you're going to put on, and what the volume and the open interest is. I mean, it's very important to make sure that we're not trying to buy something that's so far away that nobody else is trading it and there's no money in it. Take a big risk for such a small amount of money. You got to remember that there's a spread in there we have to pay plus a commission. So sometimes the further you get away from that market, you go way out, then there's no money in it. So that's why we don't do it. The closer you bring it, the more money there is in it. That's why a straddle, which is right on top of it, is the most money, but it's the most dangerous, right? I mean, the cone of probability is smaller. The further away you get from the money, the bigger the cone of probability, but the less money you make. So it's all a bell curve. It's all a bell curve. They're all basically the same. It just depends on what type of risk you want to take, how much money you want to put, where the volume's at, and what those spreads are. So we'll play with that as we sit here and do this over time. The more we work with them and the more we put them on and the more we play with them, as we sit here in the mornings and put these things on, you'll learn more and more and more. And the best thing for you to do is do what I'm doing, which is put them on, try them, see what you're doing, try them out, put on a whole bunch of them. It's hard to put them on a whole bunch of them in the stock market, because in the stock market, a whole bunch of them in the futures market, because in the futures market, we really only have a few markets that we want to trade options on. The S&P 500 is one. Some of these other markets we can trade on, but the volume's really low on them. So the S&P is really the kind of the big game in town. And then, crude oil and some of these other markets, gold, we can get in there, silver. There's a few options that we can go trade on some of these other markets, But for the most part, the one we like the best is the S&P, because we can do those 0 DTEs. Now, some of the others have 0 DTEs, obviously, but you have to wait a week or two for them to show up. They don't happen every day. They happen every day in the S&P. And so the distance between, and we'll talk about that when we start doing the iron condors and iron butterflies. Like I said, we won't really ever probably put one of these on. These are pretty dangerous strategies. Not that they're really any more dangerous than a normal contract, as I've mentioned, but because they require so much margin. $12,000 to put that thing on. That's ridiculous. I'm going to show you how to cut that right down to nothing. I'm going to show you. We'll do that tomorrow, right? And we'll put one of these on, but then we'll slam that margin amount down to almost nothing, down to a very reasonable amount of money. But I'll show you the tricks. But we're getting a little ahead of ourselves right now. We got to just kind of learn the steps step by step. So hopefully that answered your question. So let's go look at the stock market. And I'm going to pull up the stocks version, and we do have some options on there. We didn't look at them yesterday, and I haven't looked at them since we looked at them together last week, so I'm not even sure what they're doing. So we're going to come in here and take a look at our options. Which portfolio was it that we had? So let's see how we're doing. Oh, we're losing money. But that's okay. That's a good lesson for us. So we're going to come in and not sure. Oh, that's the skew and the VIX. We did that lesson yesterday. I sent out a video to those of you who are subscribed to my video newsletter. Let's save that, and I'm going to go to a different book. All right, here are our options that we did yesterday. So let's make sure we're going to go to all. We're going to go to multi-leg. We're going to open up. Let's start with Apple. Okay, here's what's happened with Apple. Let's go to chart only. So our Apple, we bought 3 options. That's all we were doing, right? We're just buying the 3 options just to watch and see what happens when you buy 3 options. We bought one that was in the money, at the money, and out of the money. And the market rallied immediately once we bought that thing. So this one here was at the money when we bought it. This one here was deep in the money. This one here was far out of the money. So let's look and see what's going on. So this one here that was at the money is our 185 call. So if we come down here and look and find our 185 call, it's the top one right there in the list. So 185 call, we're up $30. Okay, so we've made $30 on that thing. Current value is $900. We paid $870 for it. So we paid $870 for it. Current value is $900, up $30. So we're up 3.45% on that call option. You're like, what? What the hell? That's all I'm up? $30 from here to here? That's a $500 move for 100 shares. How come I'm only up $30? Because the volatility of this market started to turn and come back down, and the expiration date's not until clear out here. And you're like, whoa, what if the market comes down and then turns and goes way up again? Well, you could hang through it. That would be a loss. You'd start to show a loss. But then if it turned and rallied and went all the way back up, where's it going to hit above that line, right? Do your due diligence. So you paid how much for it? How much did we pay for that at the money option? We're going to come in here and we're going to say at the money option, we paid $870. So $870. So you're going to take your dollar calculator. You're going to draw up there. $870 is right. $870. That's about as close as I'm going to get right there. 880. So that's our break even point. Draw your line across there. The market came right up. Look at that. Came right up and touched the break even point and then backed off. So do you think it's going to continue higher, or do you think it's going to roll and come back down and hit that blue light and then go higher? What do you think is going to happen? So that's what you have to take into consideration when you buy and sell options. What do you think is going to happen? Where do you think this thing's going to go? Now, did we get in at the most optimal time? No, of course not. But it was when we were in a lesson. And that's the day we had to learn about these types of options. So we put them on. So timing is very important when it comes to options. In fact, it's extremely important when it comes to options. Timing these things is very important. That's why you have to get good at technical analysis. A lot of people miss that when they trade options. That's why 90% of people who trade options lose money, is because they don't understand the concept of options. They think, oh, I'm just supposed to put one on and then I just make money hand over fist. I'm rich, rich, rich beyond my wildest dreams. No, it doesn't work that way. In fact, most people lose money in options. It's like 90% of all options expire worthless. Well, if that's the case, you ought to be selling them, right? Well, let's do that then. Okay, these we bought these options. So in this case, 52 days until expiration, we've got more upside potential. It could turn and go and make you lots of money. So you just have to wait. Time is on your side. You got 52 days until this thing goes. But remember, 52 days also, you have time value working against you. So it's losing money every single day. And the amount of money that's losing every single day is how much the market has to move in your favor every single day just to stay break even. So let's come in. And so you're like wishing that was more money, right? You're saying, well, a little disappointed. If I'd have bought 100 shares right there, I'd be up $500. But since I bought a call option, which represents 100 shares, but it doesn't really, does it? Because we have delta. And so the delta on this thing, do we have it listed right here? We do. Look, it's only 68. So it's only making 68 cents for every dollar. So think of that as being 68 shares. You don't have 100 shares. You only have 68 shares. But you're like, even at 68 shares, I'm still not making the full amount. Well, that's because you have all that time value left. Okay. You have very little intrinsic value and you have lots of risk to the time value. Time value is opportunity value, but it's also risk value, because if the market comes against you, you got 52 days to lose money. Right. So you have to look at it both sides. If you can never see the disadvantage of your advantage, then you shouldn't take that trade. There's always an advantage and there's always a disadvantage. And if you don't know both sides, don't take the trade. Okay, so now let's come down and look at the next one. This was the far out of the money option. So far out of the money option, that one we paid $325. Its current market value is $302, so we're losing $22. Now, in the beginning, if you remember, that one was the one that was making us a lot of money. That was a big percent gainer because this market started to rally really hard in our favor, didn't it? So it kept rallying, and we were like, hey, that out of the money option is really awesome, man. That thing is making money fast. That was hand over fist, making money. Oh, I love those out of the money options. But all the market has to do is just, boom, touch a little bit in the opposite direction. Ooh, that thing's very sensitive. It loses a lot of money fast. So that little option right there, that $325, that was our 195 call, which is this one right here. We're now down $22. Okay, we're losing 6.92% because that was all implied volatility. As that market was moving towards it, it was making money. But the minute it got that one bar back, bam, it all gone. Because it's not in the money. There's no intrinsic value. There's no intrinsic value. All you're trading is extrinsic value. All you're trading is time value. So the minute the market turns and starts to go against you, man, that time value, it's like people are like, oh, market's going down, and you can say it's going up. So you're losing ground. So you not only lose the advantage of the possibility of intrinsic value, you lose the possibility you lose the implied volatility as well. So that thing collapsed, and that's why that was our big winner. Now it's our big loser. Okay, so it's down 7%, total gain down $22. Let's go to the next one. This is our deep in the money option. Now, this is going to be the one that moves the least. All right. It moves the least because it's got more intrinsic value. Okay. It's not going to be so susceptible to all of that time value, that implied volatility decay. Implied volatility, the market can barely move in the wrong direction, and the implied volatility can collapse out from under it, and you can lose a lot of money really fast. So we want to keep that in mind because that's a way we can make money really fast too. Implied volatility can be a bad thing or it can be a good thing depending on which side of the market you're on. If you can make money, if you can lose money really fast because of implied volatility, well, then that means you can make money really fast because of implied volatility. All right. So we're going to play both sides of that game. We're going to buy options when implied volatility is low. We're going to sell options when implied volatility is high. All right. Because if implied volatility is high and then suddenly it collapses out from under it, we get to make all that money. Okay. If we sold the high volatility. All right. So let's come down and look at the deep in the money. The cost base on this thing was a lot more money. It was $1,655. Okay. And our delta on it is 0.81. That means it's making, you think about it as being 81 shares instead of 100 shares, it's making 81 shares. That far out of the money option was making, has a delta of 0.41, right? So it's only making the same as if it's making 41 shares. So this is 82 shares. So that can work in your favor and it can work against you, right? 82 shares and it starts to collapse. Well, you're losing money at 82 shares versus only 41 shares, but that's why you paid more money for it. Your cost basis was 1,655, not 325. So your gain percentage is up. We're still up 529 or 5.29%. 5.29% or $87.50. It's our biggest winner right now, where it was our biggest loser before, right? Because the implied volatility doesn't affect a deep in the money option nearly as much as it does that's out of the money. So the in the money collapse, we've got more intrinsic value. We're trading actual shares here of 81 versus an actual shares of 41. We got twice as many shares of intrinsic value. So the implied volatility collapse doesn't affect it as much. Does that make sense? Okay. So if you got no intrinsic value, the implied volatility is your option is very susceptible to implied volatility. If you got a lot of intrinsic value, the implied volatility is very low. So you have to take into consideration what you want more of. Do you want more stability or do you want more implied volatility, fast money, slow money? You hear a lot of guys talk about that. Oh, this is my fast money strategy. This is my slow money strategy. Okay. We see that a lot of guys, and that's how they categorize them. This is fast money. This is slow money. Okay. So this would be a slow money strategy because it's got a lot of high volatility, meaning it's not going to be susceptible to a lot of implied volatility move. All right. So that's why we're up on this one, $90, and it's up 5.4%. Total gain, we're up $102, but that little out of the money one is pulling us down with that $22. All right. So any questions on the calls while we're looking at those? We'll go over and look at our next one. Calvin's asking, got a question here. To close a position, buy each leg to close versus buy the position to close. Which do you prefer? It depends, Calvin. When we're working with multiple situations where we got multiple options on at the same time, it depends on where the underlying market is. It has a lot to do with how much implied volatility, how much delta, which one we want to take the profits off. Like, for example, this one here, as soon as we got one little pullback on that out of the money, it would have been a good idea to pull that one off, right? That high volatility one. We could have pulled that one off and taken a little profit because it doesn't take much for it to lose. We might wanted to have keep the others on, the other legs on. So you can take the high volatility one off, take the profits out of it, let the others ride a little bit. It just depends. And we'll talk about that as we go through and we start to liquidate. We haven't really talked about liquidating options at this point. I think we did one last week, one of these call options. We liquidated it for that exact reason because it was way far out of the money. It was implied volatility. We were looking for the market to retrace. And so we took one off, and it was a multi-leg. And so we just took one leg off just to do that exact thing, just exactly what you're talking about, Kelvin. So there's no right answer. It's just different. And you'll hear me say that a lot. What's the right answer, Lan? Should I do this or should I do that? What's the best thing to do? There's lots of variables and oftentimes there's no one best thing to do. They're just different. There's different outcomes. So if you did this, it would be different than if you did this. Well, which would be better? Well, we don't really know until after it's over. So you can say, well, in the past, it would have been better to do this, but I could show you another, 50 examples where in the past it would have been better not to do that. So you say, well, over 1 million times, which one would have been better? It's irrelevant. We're not going to trade it 1 million times. So those back testings of, oftentimes you'll see people do back testing where they're like, well, I ran this thing and over 1 million times, this one outperformed that one by, 2%. So we're going to do this one all the time. Okay, if you want to, but those back tests like that are absolutely, for us small speculators, absolutely and totally unreliable information. You got to look at them individually, one item at a time. You can't look at all 1 million and say this is the best way to do it every single time, because it's not. It's just different. All right. There is no, when you're a small speculator, there is no right and wrong. For the most part, it's just different. It's going to be a different event if you do it this way, and it's going to have a different result this time. Which is better? We don't know until after the event, so we just make our best guess. I tell everybody it's a swag. All right, just don't do a wag. A wag is a wild ass guess. Everything we do in trading is a wild ass guess. We don't know what's going to happen, and saying, well, it's happened this way 1 million times in the past, and so I'm going to do it this time. If you have to look at it 1 million times, the market can stay rational longer than we can stay liquid. So we just have to take it into a consideration of what we want to do and what we feel at that moment, how we feel about it, how much risk we're willing to take, and look at the individual situation and make our decision. And sometimes, one's better than the other, and we make the right decision, and we did the one that made the most. And the other one might have made a little bit more, it might have made a little bit less. It's just different. It's not better. It's not worse. It's not right. It's not wrong. It's just different. Okay. So you try and make your best guess and make it a swag, scientific wild ass guess, because everything we do is a wild ass guess. Just try and make it as scientific as you possibly can. Do your technical analysis, read those charts, look at those indicators, make your best guess, figure out what you think that market's going to do. Do the very best you can to scientifically figure it out, and then make your wag, make your wild ass guess, and take that one off. All right. So decide whether you're going to do both or whether you're going to do them all. And it's just going to be different. It's not going to be right or wrong or better or worse. It's just going to be different. Sometimes different is good. Sometimes different is not so good. All right. That's my little rant and rave about that. I go off on that on occasion. Sorry, but that's my attitude on that. So let's go look at our positions. We're going to go to all of them. Let's look at Meta. What did we do with Meta? Meta, we sold an option, didn't we? We're learning about selling. So we actually covered one here. This is a short position because we bought a put in anticipation of the market falling. Let's bring this in here so we can see just the chart. And then we also sold one out here. So this is a naked put, a naked option that we sold, naked call. We sold a call. So think about it. If you buy a call, you want the market to go up. If you sell a call, you want the market to go down. So if you buy a put, you want the market to go down. If you sell a put, you want the market to go up. Well, we bought a put, so that means we want the market to go down, and we sold a call, which means we want the market to go down. So these things would make money if the market went down. Now let's come and look at what happened. How much, which is the put that we bought? There's our put. Okay, so we bought that put, and we bought that put for $1,430, and the market went up. Now it's coming back down, but it did go up. And so out of that $1,430 was our cost basis for the put. We're losing $300. We're losing $300 because time value is decaying and the market went the wrong direction. We wanted the market to go down, but the market went up, or it just went sideways, right? So we need the market to move when we buy an option, whether it's a put or a call. It needs to move. Can't be dead. And this market basically went dead, didn't it? Just died on us. Now, the cost basis on the option that we sold, the sell call. Now, this one here we sold, and so it's a call option, though. If you buy a call, you want the market to go up. If you sell a call, you want the market to go down or not move up, okay? If you sell an option, you just don't want the market to move up, all right? If you sell a call, you don't want it to move up. It went sideways, so that's good for us, hey, right? it's good for us. That means that the market didn't move, and so time decay is moving in our favor. That's why we're up $85. So we make a little bit of money every single day as that market dies and doesn't increase in value. So we get to collect that little bit of money every day. Now, they dropped that full $550 in our account the minute we sold that option. Boom, went into our account, $550. We're up $550. You're like, woohoo, let's take it and run. Well, you also have the other side of that trade where you have to owe $550 back if you take it and run. All right. The only way you get to keep your money, the way you make money, is time decay. When you sell an option, you have to wait for the time to go by, and you get a little bit of money every single day, and then time is how you get paid. So if you just get the 550 and say, no, I'm going to take the 550, liquidate the position and run away, you can't. You have to give back the 550. So the longer you wait, the more money you get to keep. And in this case, we've waited how many days? 1, 2, 3, 4, 5, 6, 7, 8. We've waited 8 days, and they've paid us $75 for waiting those 8 days. So now if we want to take our money and give back our option, we don't want it anymore. Well, they gave us 550. If we don't want it anymore, we only have to give back 475. All right. We only have to give back 475. So we got to keep that $75. That's our profit. And if we want to make more money, well, we have to decide, do we think that this market is going to stay going down? Do we think it's going to come up? Do we think it's going to stay below all it's got to do is stay below that red line. We got to collect all of it. So that's your cone of probability. And you're like, wait, cone of probability? I thought that was, you had a cone of probability when you had bought one and sold one, or when you had two, you could create a cone. Well, this is just a one-sided cone, right? This is just one side of the cone. So from where we got in right here to where that market's currently trading, as long as the market stays below that level, it just has to touch that purple line underneath the red line. That's what selling a call means. The market has to just anywhere below that red line, we get to keep all $550. It just needs to touch that purple line somewhere below the red line. It's like a carnival game, right? You go to the carnival and you set up the rules, and if you pick correctly, then you get the panda. You get the big panda, right? If you pick incorrectly, you don't get the big panda. You lose your money. So that's what we're doing. We're looking for the big panda, and all we have to do to get the big panda in this carnival game is have this little green snaky thing that's coming across the screen. See this little green snaky thing? As long as it stays below that red line, we get to keep all $550. It's just a game you're playing. That's the game. So the game is snaky thing, stay below the red line. We get to keep all the money. Hit that red line, right? Hit that purple line, snaky thing. Before you hit the below that red line, we get to keep all $550. That's the game you're playing. All right. Now, snaky thing on the call on the put option that we bought, it has to be below. So we're going to come in here and do our cone of probability on this one. It has to be below. How much we pay for it? $1,430. $1,430. All right. That's about as close as I'm going to get. Right there. So that's our cone of probability on this one. Let's draw our line in there. And so now all that market has to do is stay below. It has to hit the purple line below that blue line. So as long as it hits that purple line below that blue line, we make money. And that's our break even right there. If it comes and touches it right at it, then we just barely break even. But if it's inside of it, we lose it. It's got to be below that blue line. Got to be below that blue line to make money. Okay, so that's the game we're playing. This snaky thing just has to move back and forth across those lines. You draw your lines in there, decide whether the snaky thing is going to go below it or above it by that purple line, and that's how you make money. All right, guys, we've run out of time. Gone over. I'm going to jump back over. We still got a couple more stocks in here. We'll review those tomorrow, but I'm going to jump back over to the futures version. Take a look. Oh, my goodness, look at this. Oh, my goodness, look at this. Oh my goodness, look at this. We're down $30. So that big news event that Calvin warned us about, Who was it that made the market move? Who was that dirty bugger? Made that market do that? It's Bowman, 845. Yeah, 845. Old Fed Bowman. He said something that the market really liked. So again, when you got things that are going to move the market, these are not the strategies you want to put on, right? If you're going to have a market moving event, don't put on call out. But you know what? It could just flush and come right back down. So all it has to do is get inside that cone of probability. It could come right up here and stay right there. It's still inside the red boxes. It just has to be at the purple side. That's the game we're playing. That snaky thing that's coming across the screen has to just hit that purple line inside those arrows, and we still make money. Can it leave those arrows? Sure, it can, but it's just got to come back into them. And the longer we wait, those arrows get further and further apart, so they'll move in our favor. That's called convexity. We'll talk about convexity a little bit as we speak. But look, it's coming back. Look, we're already back up $65 again. Look at that horrible move against us. Horrible move against us, and we're still up $65. We're still making money. You want to liquidate? Take your $65 because you're worried it's going to turn and leave the box. Maybe it's going to turn and go up here, or maybe it's going to turn and come back down here. Who knows? Nobody knows. It's the game you're going to play. Where's that snaky thing going to go in comparison to where you've got your box, your probability box? Where's that snaky thing going to go? Do you think it's going to stay back in here and end up back down in this region here? Then you should hang on to it. If you think it's going to continue to move and leave that box and be up above that box by expiration, you should get out right now. Take your $25 profit. What do you think it's going to do? That's the game you're playing. Think it's going to stay inside there? Ooh, that's a big move. That was a big move. Let's go look at the 1 minute chart and see what that looks like on the. There we go. Look at that. Sweet. That was a nice move. That's the NASDAQ. Just going sideways, sideways, sideways. Suddenly, bam, that thing took off like a rocket ship. $830 for a single contract. Then it's flushing back down. How far did it come back down? Off the very peak to the very peak. That was $1,000 move. Now it's giving us a little trend in here. It'll give us a little like that. We're bearish with a bullish arrow. You want to take it? Do you think it's a reversal? Do you think it's going to continue to go up? Do you think it's going to be an ABC pattern? ABC. Think this thing's going to start to rocket back up again? What do you think is going to happen? Think it's going to break those arrows and go? We're still in a downtrend arrow. We got a bearish ticker with a bullish ticker. But do you think it's going to be a reversal and go back up? What do you think is going to happen? You could take a long position right here, but how's that going to affect our options? Our options were now down $17. Okay, it's starting to rally. Where's our cone of probability? What do you want to do? What are you going to do? You take a small loss, break you. Oh, we're back up $15 profit again. You want to take it while it's profitable, or you want to wait? Because if you wait and it ends up inside that thing, you're going to get a keep $970. All it has to do is end up inside that cone of probability, and you get to keep all $970. But right now, you're sitting at a $27 profit. You want to take it because you're worried it's going to leave the cone? Take it. What do you think is going to happen? What are you going to do? All right, guys. Pit News Magazine. Go get your copy. We're going to drop the December issue here soon. And class is over. I'm going to let you go home. Let you go back to trading. Take care. Have a good evening. We'll see you tomorrow. Do it again.